Are you planning to buy gold as a form of investment? That's a great idea because investment in gold acts as a hedge against your other investment in equities, real estate, etc. I mean, investing in gold reduces the risk of adverse price movements in your other investments. So basically, you are trying to diversify your risk. In fact, investment in gold is often considered a safe hedge against inflation. Over a long term, gold has delivered 11.7% annualized CAGR return in the last 12 years, 9.8% in the last 10 years, 12.3% in the last 5 years, and 16.7% in the last 3 years. So, if you are convinced that gold should definitely be a part of your portfolio and would like to stabilize your investment strategy, let's see what options are available in buying gold. We will compare and contrast these methods of buying gold against certain parameters like what they contain, the purity, platform of investing, the minimum investment amount, lock-in period, charges, risks, returns, taxes, and liquidity. The first option is to buy physical gold. The second option is digital gold. Then we have gold ETFs, gold mutual funds. Last and the very important method is to buy sovereign gold bonds. Let's see what each of these options contain and how they work. You know what physical gold is. Physical gold is mostly not considered an investment, but rather considered as an expense for personal consumption, that is, ornamental purposes. Digital gold is like the demat form of buying physical gold. Say you want to buy 20 grams of gold, you can buy the same online in an electronic form. This is digital gold. You can redeem the same online and ask for physical delivery of this 20 grams of gold or equivalent amount of cash. Gold ETFs are purchased very much like shares through your stockbroker. These gold ETFs invest in gold mining or refining companies. Each unit of gold ETF equals 1 gram of gold. Gold mutual funds invest money in a pool of gold ETFs again. Gold mutual fund is an assortment or collection of gold ETFs, just like a stock mutual fund is a collection of certain stocks. Sovereign gold bonds are just bonds issued by the Reserve Bank of India. These bonds are open for purchase by cash every few months and are held in demat form, which eliminates the risk of the loss of scrip. Sovereign gold bonds are a great and safer alternative to buying physical gold. Sovereign bonds are purely for investment purposes only. If your intention is to buy gold physically and own it, then this option is not for you. Physical gold in the form of jewelry is not very pure because jewelry can't just be manufactured with pure gold. So, certain other metals need to be added. But gold coins and bars are better than jewelry in terms of purity. Gold ETFs back their assets by physical gold of 99.5% purity. ETFs invest in gold mining companies or directly invest in 99.5% pure gold. ETFs aim to match their performance with the price of gold. Gold mutual fund, as we discussed earlier, is just a collection of gold ETFs and hence they are also backed by 99.5% pure gold. Sovereign gold bond, on the other hand, is not actually backed up by physical gold but a form of investment which gives you returns based on the price of 24 karat 999 purity gold. Digital gold can also be purchased with 999 purity, but there are certain other charges as we discuss further. Let's see where and how you can purchase these. Physical gold, as you all know, is usually purchased in a jewelry shop in your neighborhood. Digital gold is usually purchased online via many popular platforms like Paytm, Google Pay, PhonePe, and Gold Rush. These investments are ultimately managed by three companies: Augment Gold, MMTC, and Digital Gold India. You can buy and sell gold ETFs through your stockbroker, much like trading shares. Gold mutual funds are usually bought through the asset management companies or through your stockbroker as well. Sovereign gold bonds can be purchased offline by visiting certain banks and post offices or online through your stockbroker. Let's see what the minimum investment amount for each of these options is. Minimum amount of investment for buying physical gold is 1 gram. Digital gold can be bought for as little as 100 rupees. Gold ETFs can be purchased for as little as the amount equivalent to 1 gram of gold. Investment in gold mutual funds can be as little as an SIP of 1000 rupees. Sovereign gold bonds need a minimum investment of amount equal to 1 gram of gold. Let's see what the lock-in period for each of these options is. There is no lock-in period for physical gold, which means you can sell the gold anytime. This means there is more liquidity. There is no lock-in period for digital gold, which means you can sell your units at any time or ask for physical delivery of the gold with the click of a few buttons. Gold ETFs can be sold anytime on the stock exchange, just like shares. But beware, the liquidity of that particular gold ETF may be low. Gold mutual funds may charge an expense to you called exit load if you sell your units before a certain period, say for example 180 days. This means gold mutual funds also have a fair amount of liquidity. Sovereign gold bonds are only meant for long term and hence the lock-in period is 5 years. Let's see what the charges are. The first cost is GST, which is 3%. The second very important cost is the making charge, which is high depending on the location and jeweler, ranging anywhere from 8 to 12%. Let's take an average value of 10%. Adding to that, we have storage costs. For digital gold, we have to pay 3% GST, 2 to 3% storage or insurance or trustee costs. When you want to take physical delivery of your digital gold, consider adding the making charges and also the delivery charges for getting gold to your doorstep. Gold ETF companies also pay GST, but they receive credit back and hence they won't charge us. So effectively the only expenses in gold ETFs are the expense ratios and the transaction costs in buying or selling ETFs through your stockbroker. Additionally, in gold mutual funds, apart from the above charges, we need to pay a tad extra for the mutual fund manager. Let's talk about the charges in sovereign gold bonds. 0 making charges, 0 GST, 0 storage or insurance charges. Additionally, the bonus is 2.5% interest per annum on your initial investment of buying gold. Physical gold has the risk of theft. Digital gold helps you avoid the risk of theft because your gold is maintained by the companies in their vaults. But there is a risk, lack of regulatory authority. Gold ETFs and mutual funds have no risk because they come under the surveillance of SEBI. Sovereign gold bonds are not risky because they are backed by the RBI. When you sell your gold, you will have to pay long-term capital gains of 20% with indexation plus 4% cess on the gains. If you sell gold within 3 years, you will be subject to short-term capital gains tax, which means the gains are added to your taxable income and taxed as per your income tax bracket. With sovereign gold bonds, the beauty is you have the option to redeem your bonds after 5 years, and at that point of time there is absolutely no need for you to pay capital gains tax. But the yearly 2.5 interest you receive on the bonds is taxable and added to your yearly income.